In this video, we're going to explore the key financial terms used in business. These terms aren't just important for passing exams, they are actually used by real businesses. In fact, managers and business owners need to have an understanding of some of these key financial terms used if their business is to be successful. We'll look at concepts such as revenue, costs, profit, assets and liabilities. We'll explain each of the terms used and then we'll relate them to a business example to put them into some context. Before we go any further, let's meet Josh. He has recently launched his own scuba diving business called Hidden Depths Diving in Cornwall, which hosts some of the best diving in the UK. His passion for diving started at a young age and he wants to share this with others while earning a stable income for his family. Josh is still a pretty new business owner, so we have decided to go through all of the relevant key terms that he will need to know in order to run Hidden Depths. To all the teachers out there, show all of these videos without any ads and gain access to our growing library of over 500 teaching worksheets. Why not visit BizzWizard.co.uk to find out more? Let's start by looking at revenue. Revenue is money coming into the business from the sale of goods or services. It is calculated as quantity sold multiplied by the price per unit. This month, Josh has sold 125 diving experiences at £100 each. So his revenue for the month is £100 times by 125, which equals £12,500. Next, we need to look at costs. Costs are payments made by the business that it needs to make goods or provide services. There are a few different ways that costs can be classified. Firstly, there are startup costs. These are the one-off costs for items that the business needs to start up. When Josh set up Hidden Depths, he had to pay for a website, buy diving equipment, and create publicity materials such as flyers so that people knew his diving school was about to open and where it was. And then there's operating costs. These are the ongoing costs that the business has on a day-to-day basis. Josh has to pay the telephone and the broadband costs, as well as the electricity costs for running his office. There are fixed costs. These are costs that do not change with output or use. Josh has to pay rent on his office regardless of how many sales he makes, so this is a fixed cost. It's not going to change dependent on how many experiences Josh sells. And then there's variable costs, which on the other hand are costs that do change depending on output or use. The more sales that Josh has, the higher the credit card fees he will pay on those transactions. In another example of a sandwich shop, the more sandwiches are sold, the more bread is needed. The bread here is a variable cost. And then there's direct costs. These are costs directly linked to the production of a product or a service. For Josh's diving school, the cost of the diving gas used by his customers when they are on their dives will be a direct cost, as it's linked to the service that he provides. And then there's indirect costs. These are costs that are not directly linked to the production of a product or service. In Josh's business, this could include the costs of running his website. And we shouldn't forget total costs, which is, well, the fixed costs plus the variable costs, the direct costs plus the indirect costs. It's basically, the total costs. And all of these costs are known as expenditure, which is another name for money being spent by the business. And finally, you need to know the term overheads. These are the everyday running costs of the business, such as the rent for Josh's office. So, now that we have looked at revenue and we have looked at costs, next it's time to talk to Josh about profit and loss. Profit happens when revenue is greater than expenditure. So if Josh's revenue for the month is £12,500 and his expenditure is £10,000, then he will actually make a profit of £2,500. Now, with a loss, well, this happens when expenditure is greater than revenue. So if Josh's revenue for the month is £12,500 and his expenditure is £14,000, then he will actually make a loss of £1,500. We will look in much more detail at break even. This is the point where you make no profit or loss. Revenue and costs are exactly equal. So if Josh's revenue for the month is £12,500 and his expenditure is £12,500, then he will be at the break-even point, as he has made no profit, but he has also made no loss. And you will also need to know the margin of safety. It sounds complicated, but this is just the difference between the break-even point and the actual number of units sold. So, if Josh's break-even point is 100 units, meaning 100 diving trips must be sold for him to break even, but he's actually sold 125 diving trips, then his margin of safety is 25 units. He is basically 25 units over the amount that he actually needs to break even. Bring this video and over 100 more to life with fun, interactive games, quizzes and case studies. Why not try the first 25 completely free by visiting BizzWizard.co.uk. Now, going back to profit, it's important that Josh understands that there are different ways of looking at profit, the money left over. Firstly, you could consider the gross profit. This is the profit that is made directly from each item that is sold before the costs of running the business are taken into account. It is calculated as revenue minus cost of sales. The cost of sales are the costs directly related to the service or the goods being sold. If Josh was just simply selling chocolate bars, then his cost of sales might be the price that he paid to buy the chocolate bars from the supplier. His gross profit would be the difference between the revenue, the price the chocolate is sold to the customer, and the cost of the sales, the price that the chocolate was bought from the supplier. In Josh's business, cost of sales include the cost of the diving gas and the logbooks that he provides to each diver. So Josh's gross profit would be the selling price of the dive experience, less the costs of the gas and the logbooks. We now know this to be his costs of sales. But then he could just consider net profit. This is the profit that is made after all costs have been deducted. This is basically what you are left with at the end of everything. It can be calculated as revenue minus all costs, or gross profit minus all other expenditure. Josh's net profit can be calculated by taking his gross profit and then deducting all the other running costs of his business, the rent, the IT costs, the wages. It would be a really good idea for hidden depths diving to actually complete a budget. A budget is a plan of inflows and outflows of money within a business or an organisation. There is a revenue budget. This is a plan of the expected inflows within an organisation. How much sales money should actually be coming in, or I guess we could say flowing into the business. And then there's an expenditure budget. This is a plan of the expected outflows within an organisation. How much are the costs actually likely to be? And then there's budgetary control, which is basically the process of checking the planned budget against the actual performance of the business. Did they hit what they expected? Were they under? Were they over? Etc. Josh agrees that this would really help him understand his business performance better, and we have offered to help him pull all of this information together. Now, we explained to Josh that it would be really important to look at his cash flow forecast, so he knows how much money is expected to go in and go out of the business and what his cash balances are likely to be. So, a cash flow forecast is a document which details a prediction of the inflows and the outflows of money within an organisation or business. The net monthly cash flow is the difference between the predicted inflow and the predicted outflow for each month. If this is a positive value, then things are looking good. If this is a negative value, then there may be some worries ahead. It's important to understand the opening balance of a cash flow forecast document. This is the figure that has been carried forward from the previous month's closing balance. How much money did they have on the last minute of the last day of the last month? That number, of course, is the opening balance for the next month, just minutes later. And then there's the closing balance. This is the figure that is in the organisation's bank account at the end of the current month, and as we just explained, this will become the opening balance of the next month. We explained to Josh that he can use the information that he has put into his budget to start to prepare a cash flow forecast for hidden debts. That way, Josh will be able to keep track of his cash better and can plan ahead if it looks like he's going to need to find more cash somewhere to cover all of his costs. Each of the video courses over at BizzWizard.co.uk also includes an interactive business case study that applies the knowledge learnt to a real-world scenario. There are over 1,000 multiple-choice questions, each with detailed feedback, which tests students' understanding of the content. Why not visit BizzWizard.co.uk to find out more? Now, there are some key financial statements that Josh also needs to be aware of. Firstly, he, and I guess you, need to understand that financial statements are documents that show how the business is performing financially. There's the income statement. This is the document that shows the profit or loss of an organisation. It's also sometimes known as a profit and loss statement, or a P&L for short. And then there's the statement of financial position. This is the document that shows the value, assets and liabilities of an organisation, and where the capital has come from. It's also known often as the balance sheet. Josh hasn't really looked at the statement of financial position or a balance sheet before, so let's explain the key terms used in these important documents. Firstly, he needs to be aware that assets are something that a business owns. It belongs to the business. A business will have current assets. This is cash or near cash, so this would include the money sat in the bank or stock, as this can be turned quickly into cash. A business will have fixed assets. These are items that help keep the business running and do have a value, but may take longer to turn into liquid cash. Josh's diving equipment, computer, and tills are all good examples of fixed assets. You may also need to know about trade receivables. These are customers who have been given credit and owe the organisation money. Josh recently ran a diving event for a local youth group. He sent them an invoice and they are due to pay him at the end of the month. This is an example of a trade receivable. A business like Josh's will have liabilities. This is something that a business owes, a debt that they have. There are current liabilities. This is something that the business owes that has to be paid within 1 year. Josh has to pay VAT to the HMRC at the end of each quarter. This is a current liability. And then there's long-term liabilities, something that the business owes that has to be paid over a period longer than 1 year. Josh took out a bank loan when he started his business, which needs to be repaid in 3 years' time. This is an example of a long-term liability. Now, you will also need to understand what an overdraft actually is. You will likely get your first personal overdraft when you head to university, and it is basically a short-term bank loan that is usually reasonably expensive for a business. Josh sometimes has to dip into his business overdraft for a few days if he needs to pay some of his bills before his customers have paid their invoices. He tries to avoid this as much as possible, as the interest rate is actually pretty high. Now, you may hear about trade payables. These are people or companies that the business has to pay who have given it credit. Josh's web designer gives him 60 days to pay his invoices. When these invoices are waiting to be paid, they are part of Josh's trade payables. Then there's working capital. This is the money in a business on a day-to-day basis, the money that they actually have to hand. It is calculated as current assets minus current liabilities, the things the business has minus the things the business owes. We're going to talk a great deal about retained profit. So this is the profit that a business has kept from a previous year after they have paid for everything. They brought forward this profit that has been made into the next year. It is retained, kept back. Josh only set up his business this year, so he doesn't actually have any retained profits yet. But say after all expenses and taking his own salary at the end of the year, there was a profit of £10,000 that would be carried forward into the next year. This would be considered as Josh's retained profit. Finally, the one that sometimes confuses students is just good old capital. Don't let this confuse you. This is just another fancy word for money. Owner's capital, owner's money, investor's capital, investor's money. And well, that's it. As you can see, there's lots of key financial terms that Josh needs to be aware of to run his business, and that you'll need to be comfortable with for your exam. We will explore each in much more detail over the upcoming videos as we continue to explore the all-important finance function within a business. Until next time though, this has been the BizzWizard.